Risk-adjusted forecasts for investors. Clear, credible English. Welcome. Today we'll make your forecast sound credible to serious investors. Remember, investors buy the future, not the hype. Big top-line numbers without risk context can mislead and hurt trust. A smart forecast is risk-adjusted. It reflects probability-weighted outcomes, not wishful thinking. Instead of a single heroic target, you show a distribution. What likely happens, what could go better, and what might go wrong. This approach signals discipline, aligns expectations, and helps decision-makers compare you fairly with other opportunities. By the end, you'll frame numbers the way professionals do: transparent, testable, and tied to risk. Start by laying out 3 scenarios: base case, upside, and downside. The base case is your most plausible path. Upside captures favorable breaks. Downside covers setbacks. Then attach explicit probabilities so listeners see your conviction and uncertainty. For example, 60% base, 25% upside, 15% downside. Finally, speak in ranges, not single points, e.g., $4.06 arranged by, not $5 million. Ranges acknowledge volatility, reduce false precision, and invite questions about drivers. This structure keeps your story honest while highlighting where execution can meaningfully change outcomes. Trade adjectives for proof. Anchor claims to data sources: internal cohorts, signed LOIs, pipeline conversion, audited financials. Tie assumptions to leading indicators: trial to paid conversion, weekly active users, qualified pipeline, churn trends, or sales cycle days, so progress can be tracked in real time. Cite comparable benchmarks from peer companies, market reports, or public filings to validate rates like gross margin, retention, or sales productivity. When you say, "We estimate 30 to 35% conversion based on last quarter's 200 trials and 2 industry studies," you replace hype with evidence and earn credibility. Identify key risk drivers: technology performance, market demand, and regulatory or compliance timing. Tell investors how each affects outcomes. Then show sensitivity to 2 to 3 variables. A 5-point change in conversion shifts arranged by $1 to 1.5 m. A 2-month procurement delay pushes revenue by 1 quarter. Convert uncertainty into business terms by translating it into revenue/EBITDA ranges. For example, at 75 to 80% gross margin and current CAC, EBITDA ranges from -5% to +8% in year 1. You're not guessing, you're quantifying the levers that actually move results. Words matter. Use "we estimate," "we expect," or "our model suggests," not absolute will. This signals humility and rigor. Prefer "if X, then Y" structures. If conversion reaches 25% by Q3, then arranged by exits the year at $6 to 7 m. Replace vague adverbs with specific metrics and dates. Say, pilot targets 15 logos by June 30th with greater than 20% paid conversion, not quickly scale pilots soon. Precision invites accountability and shows you run the business by numbers, not narratives. Here's a compact, investor-ready forecast. Base case, 60%. 20% win rate on a 200-account pipeline yields $4 to 6 m, arranged by given current ACVs and sales capacity. Upside, 25%. Channel partners add qualified leads and shorten cycles, lifting arranged by to $8 to 10 m, assuming enablement is complete by Q2, and partner-sourced deals hit 30% of closes. Downside, 15%. Model drift forces retraining and slows onboarding, delaying expansions. Result is $1 to $2M, arranged by with higher support costs. This frames ambition, evidence, and one view. No fluff, just probabilities and ranges. Make your assumptions explicit. Example, top 3. 1. Win rate improves to 20 to 22% by Q4. 2. Average ACV holds at $40 to $50K. 3. Time to value stays under 30 days. For each risk, state a mitigation plan. Model drift right pointing arrow monitoring and fallback models. Partner ramp right pointing arrow certified training and co-selling quotas. Procurement delays right pointing arrow pre-approved security packages. Commit to an update cadence. Will refresh forecasts monthly and outside the cycle if conversion shifts by plus or minus 3 PTS or churn exceeds 5% monthly. Triggers build trust that you'll course correct early. Lead with probabilities and ranges so outcomes feel realistic, not binary. Put evidence over adjectives, reference pipeline data, cohort metrics, and recognized benchmarks. Show you price risk and manage it by naming drivers, testing sensitivities, and explaining mitigations. Use precise language. We estimate, if X, then Y, and concrete deadlines and metrics. When your forecast is transparent, probability weighted, and continually updated, investors can quantify upside, understand downside, and believe your execution plan. That confidence is often the difference between interest and investment.